Institutions do not aim to be right in theory. They aim to be positioned when conditions snap. Another critical hook is this. Institutions flip long, not because conditions look safe, but because risk has become mispriced. When markets suppress volatility for too long, the eventual adjustment becomes violent. Those who identified that mispricing early position themselves where convexity exists, limited downside, exponential upside. This is where smart capital thrives, while reactive capital hesitates. Retail investors often ask what the catalyst will be, but institutional investors ask a different question. Where is the system most fragile? When enough fragility concentrates in one area, positioning changes before the trigger ever appears. That is why these moves often look sudden to the public, even though they are the result of months of internal analysis. The most powerful insight is this. Institutional positioning is not a prediction of events. It is a response to structural pressure already forming. By the time that pressure becomes visible through economic data or media coverage, the advantage is already shifted. Those who understand this do not chase moves. They recognize signals, align early, and let the system reveal what it was hiding all along. But China's policy actions never operate in isolation, and when a ban is announced with a clear start date, markets should treat it as a countdown, not a debate. In economic terms, this is a deliberate supply-side intervention, and supply shocks do not wait for sentiment to adjust. They immediately begin altering behavior across producers, intermediaries, and end buyers. The moment a restriction becomes credible, forward contracts tighten. Inventories are reassessed, and strategic stockpiling accelerates. The clock does not start when the ban begins. It starts the moment the market believes it will. Game over. Not because the world suddenly became calm, but because the rules just changed. When JP Morgan flips long and China's ban countdown hits 4 days, that's not noise. That's a signal. A signal that the old system is under pressure and the smart money is positioning before the crowd even understands what's coming. Today is not about panic. Today is about awareness, timing, and power. When a financial institution of JP Morgan scale changes its market positioning, it is never a casual adjustment and it is never driven by emotion. This is a systemically important bank with access to real-time liquidity flows, counterparty risk data, and global macro intelligence that retail investors and even most professionals never see. A flip from a defensive or neutral stance into a long position signals a deeper recalibration of risk assumptions, not a short-term trade. That single move quietly tells the market that the probability distribution of future outcomes has shifted, and those closest to the system are acting before that shift becomes visible to the public. Here's the hook most people miss. Large institutions do not wait for confirmation from headlines, economic reports, or social sentiment. By the time consensus forms, the opportunity is already priced in. Banks like JP Morgan operate on forward-looking stress models, not backward-looking narratives. They measure pressure in funding markets, derivatives exposure, and settlement risk long before volatility appears on a price chart. When positioning changes at this level, it reflects an internal recognition that the current equilibrium is unstable. This is how regime changes begin in financial markets, quietly and without public warning. The surface appears calm, but beneath it, capital is moving with intent. Liquidity is being reallocated. Hedges are being unwound, and exposure is being built where asymmetric upside outweighs downside risk. That is not speculation. It is calculated survival strategy. Here's the hook most overlook. Demand does not need to surge for prices to reprice. All it takes is constrained availability in a system built on continuous flow. Modern markets are optimized for efficiency, not resilience. When a major supplier signals withdrawal or limitation, even temporarily, the entire pricing structure must adjust to compensate for risk. That adjustment rarely happens smoothly. It happens in jumps, gaps, and sudden repricing events that catch unprepared participants off guard. China's role in global supply chains magnifies this effect as both a dominant consumer and a strategic controller of key inputs. Any restriction it imposes ripples far beyond its borders. Refiners, manufacturers, and financial intermediaries begin competing for fewer units. And competition in tight markets always expresses itself through higher prices and rising volatility. This is not speculation, it is textbook economics playing out in real time. Another critical hook is timing. A ban with a known start date compresses decision-making into a narrow window. Producers accelerate shipments, buyers pull forward demand, and middlemen reduce exposure to uncertainty. This front-loading behavior drains available supply before the official policy even activates. By the time the ban takes effect, the market is already tighter than models predicted, and price discovery becomes disorderly. Policy-driven supply shocks also expose leverage hidden in derivative markets. Paper contracts assume deliverability under normal conditions, when physical availability tightens. The gap between contractual promises and real-world supply becomes visible. That gap forces repricing, margin stress, and forced positioning changes, particularly among participants who relied on stable access assumptions. The most overlooked insight is that bans do not need to be permanent to cause lasting impact. Temporary restrictions reshape expectations, and expectations drive long-term pricing behavior. Once participants realize supply can be restricted with little warning, risk premiums rise permanently. Markets do not forget policy shocks quickly. They reprice trust, reliability, and access, and those adjustments persist long after the initial restriction fades. The widening gap between paper markets and physical reality is one of the most underestimated risks in modern economics, and it grows quietly until it can no longer be ignored. Paper markets are built on leverage, assumptions, and confidence that delivery will be available, confidence that contracts can be rolled, and confidence that liquidity will always appear when needed. Physical markets operate on an entirely different principle: availability. When these two worlds drift too far apart, price no longer reflects reality, it reflects belief. And belief is fragile. Here's the hook most people miss. Paper prices can be controlled temporarily, but physical scarcity cannot be negotiated. Derivatives, futures, and synthetic exposure can create the illusion of abundance, but they do not create supply. When physical demand tightens and inventories thin, paper markets are forced to confront constraints they were never designed to handle. The confrontation is rarely gradual. It happens suddenly when one failed delivery or one stressed settlement exposes how thin the margin really is. This gap widens during periods of complacency. When volatility is suppressed and confidence is high, leverage increases. More claims are written against the same underlying asset. On paper, everything looks stable. In reality, the system becomes brittle the moment physical flows slow or policy disrupts supply. The mismatch becomes visible. At that point, price is no longer set by models or sentiment. It is set by who can actually deliver. Another critical hook is that convergence is inevitable. Paper markets cannot remain disconnected from physical constraints indefinitely. History shows this repeatedly. When convergence begins, it is not polite. It forces repricing, margin calls, and abrupt shifts in positioning. Participants who relied on paper liquidity discover that liquidity vanishes precisely when it is needed most. Those holding physical assets or secured access suddenly gain leverage they never had before. The danger lies in how invisible this process is until late stages. Most participants track charts, indicators, and narratives, while the real signal sits in inventories, delivery delays, and rising premiums in physical markets. These are not headlines, but they are warnings. When physical premiums rise, while paper prices stagnate, tension is building beneath the surface. The most powerful insight is this: paper markets set prices until they don't. Physical reality always wins, but only after belief has been exhausted. When that moment arrives, adjustments are not incremental, they are decisive. The gap closes fast, and those who understood the difference between claims and control are already positioned while everyone else is asking how it happened so quickly. Volatility is widely misunderstood because it is framed as destruction, when in reality it functions as a transfer mechanism within the financial system. Markets do not eliminate wealth during periods of instability. They reassign it from those who are unprepared to those who are positioned. This distinction is critical. Every surge in volatility exposes imbalance, leverage, and poor risk management that accumulated during periods of calm, What looks like chaos on the surface is, underneath, a recalibration of ownership. Here's the hook most investors resist. Volatility does not arrive randomly, and it does not punish everyone equally. It targets fragility. When prices move violently, it is not because fundamentals disappeared overnight, but because weak structures could no longer support accumulated stress. Those operating with excessive leverage, short-time horizons, our emotional conviction, are forced to exit at the worst possible moment. Their exits provide liquidity to those who anticipated instability and waited patiently. Periods of low volatility create dangerous confidence, risk premiums compress, leverage expands, and strategies that work only in stable environments become dominant. The system begins to reward exposure over discipline. This is when wealth becomes vulnerable. The moment volatility returns, those same strategies unwind simultaneously, amplifying price movements and accelerating the transfer process. What appears to be panic selling is often forced selling. Margin calls, risk limits, and capital constraints doing exactly what they were designed to do. Another crucial hook is that volatility creates opportunity by widening dispersion. Not all assets move the same way, and not all participants react identically. Skilled capital thrives in dispersion because it allows differentiation between price and value. During volatile periods, mispricings emerge rapidly, offering asymmetric opportunities to those with liquidity and conviction. This is why professional investors prepare for volatility rather than fear it. They understand that uncertainty expands the field of opportunity. It is also important to recognize that volatility rewards patience. Short-term traders often mistake movement for opportunity, but sustained wealth transfer occurs when longer-term participants absorb risk others cannot tolerate. Time becomes an asset. Those who can wait while others are forced to act gain control over price discovery. The most overlooked reality is that volatility reveals truth. It strips away narratives, exposes assumptions, and forces markets to confront reality without cushioning. Once volatility begins, it does not ask who deserves to win. It simply redistributes outcomes based on preparation, resilience, and clarity. Those who understand this do not chase stability. They build structures that benefit when the system is tested. Public confidence almost always trails structural change, and this lag is one of the most reliable patterns in economic history. Markets move first, capital reallocates second, and belief adjusts last. By the time confidence aligns with reality, prices have already shifted. This delay is not accidental. It is built into how information flows, how narratives are protected, and how people psychologically process change. Structural shifts are uncomfortable, and discomfort is something systems try to postpone. Here's the hook most people ignore. Confidence is often highest right before conditions deteriorate. Stability creates complacency, and complacency suppresses questions. When systems begin to weaken, the first response is reassurance, not alarm. Official data remains backward-looking, institutions communicate continuity, and media narratives emphasize control. Meanwhile, capital is quietly repositioning, responding to signals that are not designed for public consumption. Economic structures change through pressure, not announcements. Liquidity tightens, counterparty risk rises, and policy constraints begin to bind. These are not immediately visible to consumers or even to many investors. They show up first in funding markets, spreads, and positioning behavior. Those who monitor these areas see the shift early. Everyone else sees confidence on the surface and assumes stability beneath it. Another critical hook is narrative inertia. Once a dominant story takes hold about growth, stability, or control, it persists long after its foundations weaken. Institutions are slow to challenge narratives they help create, and individuals are slower still. Admitting change requires admitting misjudgment, and markets resist that psychologically. This creates a gap between what is happening and what is believed, and that gap is where opportunity forms. As structural pressure builds, the system relies increasingly on credibility rather than capacity. Confidence becomes a substitute for strength. This works until it doesn't. When confidence finally cracks, it does so abruptly, not gradually. The adjustment feels sudden to the public, but in reality, it is the release of pressure that has been accumulating for months or years. The most powerful insight is that Confidence does not drive markets. Markets drive confidence. Price action, capital flows, and policy responses reshape belief after the fact. Those who wait for confidence to change are always late. Those who understand the lag position themselves during disbelief, not agreement, and recognize that the loudest reassurances often appear at the moment when structural change is already irreversible. Preparation consistently outperforms prediction because markets reward structure, not certainty. Prediction depends on being right about timing, magnitude, and sequence, while preparation depends on resilience, flexibility, and positioning. In complex economic systems, outcomes rarely unfold exactly as forecast. What matters is not guessing the future, but being able to operate effectively across a range of outcomes. This is why the most successful participants spend far less time predicting and far more time preparing. Here's the hook most people underestimate. Predictions create emotional attachment, while preparation creates optionality. When someone commits to a single forecast, they become psychologically invested in being right. That attachment narrows perception and delays adjustment. Prepared participants do the opposite. They assume uncertainty, design for volatility, and remain ready to act regardless of how events unfold. This mindset allows them to move decisively when conditions change, rather than freezing in disbelief. Economic preparation begins with risk management, not return chasing. It involves understanding exposure, liquidity needs, and downside tolerance before opportunities appear. Those who prepare ensure they can survive adverse conditions long enough to benefit from favorable ones. Survival is not passive, it is strategic. It creates staying power, and staying power creates advantage when others are forced to exit. Another powerful hook is that preparation reveals opportunity faster than prediction ever could. When structures are in place, capital reserves, diversified exposure, clear decision frameworks, signals stand out. Prepared participants recognize mispricing immediately because they are not scrambling to adjust. They are already aligned to respond. This is why institutional investors focus on scenarios instead of forecasts. They do not ask what will happen. They ask what they will do if it does. Preparation also neutralizes fear. Volatility feels threatening only to those without a plan. When outcomes are anticipated within a framework, uncertainty becomes manageable. This psychological stability is an economic asset. It prevents forced decisions and allows rational allocation when emotions dominate the crowd. The deeper truth is that markets do not reward intelligence as much as discipline. Brilliant forecasts fail without execution capacity, while modest insights succeed when backed by preparation. Over time, this difference compounds. Those who prepared early appear lucky when events unfold. But their advantage was built long before the outcome was known. They were not waiting for clarity, They were building readiness while others were searching for certainty. So here's the real question you must ask yourself tonight. Will you wait for confirmation, or will you trust preparation? Because by the time everyone agrees something big is happening, the door is already closing. Game over. Doesn't mean the end. It means a new phase has begun. The ones who stay alert, disciplined, and informed don't just survive these moments, they rise through them. And stay sharp, stay focused, and remember, history never roars the late.